Hi friends, in this video I am going to explain you about dividend theories. This is one of the important subject matter and topic in the financial management as well as corporate finance. Right. So, as far as the dividend theories are concerned, there are the payment of dividend has two different effects. So whenever there is a payment of dividend, it is the increases the share stock price as well as it also reduces the funds available for investments. Normally they are the two opposing effects. Maximization of the company's value is closely linked with to maximization of the shareholders wealth. So basically, what happens here is the opinions regarding the effect of dividend decision of a company in its valuation of a, see, this is totally contradictory from one subject expert to the another subject expert. One school of comprises that people like James C. Walter and Marion J. Warden who believe that current cash dividends are less risky than future capital gains. The supporters of one school thought are of the view that the company's dividend decision is relevant and influenced to a great extent. So they say that investors prefer those firms which pay regular dividends and such dividends affect the market price of this share. Another school linked to Modigliani-Miller and residual theory, they told that investors don't really choose between future gains and cash dividends. The supporters of another school thought hold the option the company's dividend decision is irrelevant. Whether they are paying the dividend to the shareholders or don't pay the dividend to the shareholders, the company value of the share doesn't change at all. So it is totally the share wealth holders' wealth remains unaffected by its dividend decision. The theory of relevance is supported by the Walter and Gordon, and the theory of irrelevance propounded by the Modigliani and Miller. So there are two types of theories: dividend relevance theory and dividend irrelevance theory. The dividend relevance theory is Walter's model and Gordon's model, whereas dividend irrelevance theory, Modigliani-Miller approach and residual theory. So I am going one by one in clear cut manner in this video. Right. First, I will go for the dividend relevance theories. Right. Dividends paid by the firms are viewed positively both by the investors and the firms. Every time the investor wants to get the dividend from the firm, and the firms don't pay dividends or rated is oppositely by the investors, it affects the share value of the company. And there are two main theories, that is Walter and Gordon. First, the dividend relevance theory. According to relevance theory, dividend decision affects the value of the firm. It's called relevance theory. Whereas, first, I will go for the Walter's model theory. What exactly it mentions here? According to Walter's model, value of the firm depends on the firm's earning level, dividend payout, constant reinvestment rate, and shareholders' expected rate of return. Here, the total model is based on rate of return on investment, or also known as internal rate of return. Means instead of paying the company dividend to the shareholders, if the same amount which they are investing in the internally, how much amount of rate of return they are expecting, that is known as the internal rate of return. Whereas cost of capital means minimum required rate of return by the investor from his investment is known as the cost of capital. So the total theory based on the return on investment or internal rate of return or cost of capital. In this model, they have been divided the firms into three groups, right? First, the growth firm and the normal firm and declining firm. So, in this model, they are having some assumptions. Before I go for detailed manner about the growth form, in normal form and declining form, I would like to discuss some of the assumptions on the Walters model. Right. In this, internal financing means no external financing at all. So, to assume that all the investments made by the company or out of retained earnings is not realistic, even though, but they are taking that the internal financing is the main factor as far as the Walters model is concerned. Retained earnings are the only source of finance. This means the company doesn't rely upon external funds like debt or new equity capital. That is the first assumption, internal financing. Second one, constant return and constant cost of capital. Constant return means the internal rate of return and the cost of capital of the firm are constant. The business remains risk remains same for all the investment decisions. So the another one is constant EPS, earnings per share, and DPS, dividend per share. Beginning earnings and dividends of the firm never change, though different values of EPS and DPS may be used in this model. They are assumed to be remain constant while determining the value of the share. The other assumption is 100% payout retention. All the earnings of the company are either reinvested internally or distributed as a dividend, the 100% retention or payout. They wanted to distribute the dividend to the shareholders, or they wanted to retain the total earnings. Then, infinite life means the company has an infinite or very long life, means the company is eternal. The companies have a perpetual succession. It is a permanent in nature. So these are the five assumptions as far as the Walter models are concerned. Again, I'm going to tell you: internal financing, no external financing; constant return and constant cost of capital; constant EPS and DPS; 100% payout or retention; the company is having infinite life. Then, what are the implications of the model? As I mentioned earlier, there are growth form, normal form, and declining form. What exactly the growth form means? Growth forms are characterized by the internal rate of return is always more than the cost of capital. It means the firm can invest whatever the earnings they have within the internally, they are going to more return than if they go for outside. Means these firms will have a surplus profitable opportunities to invest. Because of this, the firm is in the growth phase, can earn more return for their shareholders in comparison to the what the shareholders can earn if they reinvested the dividend somewhere else. Hence, the growth firms are optimum payout ratio is zero. Means they are not going to pay any amount to the shareholders as far as the growth firm is concerned, because the internal rate of return is always higher than the cost of capital. Means the shareholder can invest within the firm will get more return than if he invest in the outside the firm. That is what we call growth firm. Then normal firm. Normal firms have an internal rate of return is equal to the cost of capital. There are not any investments available for the firm that they are yielding higher rates of return. Thus, dividend policy has no effect on market price. Whereas declining form means the or rate of return is less than the cost of capital, means whenever declining firms have always have the internal rate of return less than the cost of capital, means they make returns that are less than what shareholders can make on their investments if firm distributes dividends to the shareholders. So it is illogical to retain the company's earnings in the company itself. In fact, the best scenario to maximize the price of the share is to distribute entire earnings to the shareholders. The optimum dividend payout ratio in such situations is 100%. In the growth firm, dividend payout ratio is 0%, normal firm it is irrelevant, whereas in the declining firm, dividend payout ratio is 100%. So I will go in nutshell. If rate of return is more than the cost of capital, it should be zero payout, less than 100%. If it is equal to the rate of return is equal to the cost of capital, the firm is indifferent between dividends and investments. This is Walter concludes, the optimum payout ratio is nil in case of growth firm, payout ratio is constant, uh, firm is irrelevant, but optimum payout ratio is 100% in the declining firm. See, what is the mathematical representation? E has given D by KE means cost of capital, or by KE, E minus D, KE means where P is equal market price of the share, D is equal dividend per share, and R is rate of return on the firm's investments, K is cost of equity capital. These are the E is earnings per share. These are the mathematical representation of the Walters model. Then, what is the criticism of the Walters model? Though they have given the dividend relevance theory, there is a certain criticism is also there as far as the Walters model is concerned. What is the first criticism? No external financing. Basically, to assume that all the investments made by the company are out of retained earnings, basically and normally, eventually, it is not at all realistic. However, in practice, it is an appropriate combination of the retained earnings and the external sources of funds. Then second one is a constant return. The model assumes and postulates and represents a constant rate of return. It may also not be possible in real life situations. And constant cost of capital. So the constant cost of capital forms risk which changes over time. So the constant R and K are basically not found in real life, because as and the firm invest more, the business risk also changes. So that is about the Walters model. Then coming back to the Gordon's model. In the Gordon's model, just I will go for the assumptions first, then I will also go for the what exactly the theory consists. Here, the same assumptions, all equity company means the total Gordon's model is concerned with rising from the equity capital only, no debt at all. So this is the difference between the Gordon's model and Walters model. The Gordon's model is totally rising funds from the equity capital only. There is no debt involved in this. No external financing is available. Similarly, as Walters model, retained earnings would be used to finance any expansion of the firm. And a constant return, which ignores diminishing marginal efficiency of the investment. So, constant cost of capital, as it is similar nature of Walters model. Then perpetual stream of earnings of the firm means it is basically the company as well as its sources of earnings are perpetual in nature. Means the company always gets its earnings. It is a continuous in nature, permanent in nature, and corporate taxes don't exist. It is not existing any corporate taxes. Total absence of corporate taxes in this model, and the constant retention ratio. This is most important in Gordon's model. What is the retention ratio? The percentage of earnings retained. That is retention ratio. Once determined continues to be same, which results in the growth rate. Here the growth rate is equal to the B or C. Or B is constant, and or is the rate, retention ratio. Here the growth rate is always equal to the B or stays constant at this case. And the last one, very important in this Gordon's model, the key concept, the key point has to be understand by everybody is the cost of capital is greater than the growth rate. Here the cost of capital is presumed to be more than the growth rate. If this presumption is not met, it is very difficult to arrive at significant value for the share. So, cost of capital should always be greater than the G. G means growth rate, that is retention ratio. And fraction B here, fraction of earnings the firms flows back. Mean what is the retention ratio is should always be less than the KE. KE should always be greater than the growth rate of the firm. Then, what exactly the theory indicates? According to the Gordon's model, dividend per share is expected to grow when earnings are retained. So dividend per share will be growing if when earnings are retained in the company. So the dividend per share is equal to the payout ratio multiplied by earnings to determine the value of the firm. Therefore, based on the dividend growth model, the value of the firm will be like this. So P0 is equal to earnings per share 1 minus B by K minus G. Here 1 minus B the payout ratio of the firm, given B as the retention ratio. G is the growth rate of the firm. Here, if K, E or K is greater than the G, otherwise what will happen? It will become a 0 or minus. So it is very difficult to attain the share value of the company. Right. So what exactly the conclusions are given here is the market value, the P, price market value of the share increases with retention ratio B. For firms, the similar nature of the Walters model. If it is a R is greater than K, the market value increases with the retention ratio B. And the market value of the share increases with payout ratio for declining firms. The market value is not affected by the dividend policy where R is equal to K. The criticism, it is also similar in nature. There is no external financing and it is applicable to all equity firms only. Debt, see, the Gordon's model only applicable to all equity firms is assumed that the rate of return is constant. However, it decreases with more and more investments. Cost of capital is also constant. However, it is not realistic in real situations, and it also ignores business risk, which has a direct impact on the firm's value. This is the criticism as far as the Gordon's model is concerned. And then the dividend irrelevance theories means first is Modigliani and Miller approach. These are the different school of thought for Franco Modigliani and Martin Miller has propounded this. So, what exactly they told in this approach, this is support of the irrelevance of the dividends. Means for firm's dividend policy has no effect on either price of the firm stock or its cost of capital. So, it is the total dividend policy is irrelevant as far as the market value of this share is concerned. So, what are the main assumptions here? See, perfect capital markets. Here, the firm operates in a market which all investors are rational and they have freely information available to all the investors, and transactions and quotation cash are not available and don't exist. No investor is large enough to influence the price of the share. Whatever the features of the perfect capital markets and perfect markets, the same assumptions are also applicable to the M&M approach. Then, taxes don't exist, no taxes, no tax discrimination between dividend income and capital appreciation. The assumption is necessary for universal applicability of the theory, since the tax rates or provisions to tax income may be different in different countries. So, this is universally applicable. The third one is the firm has a fixed investment policy. It is, let us understand that it is necessary to assume that all the investments should be financed through equity only, since implication after using debt as a source of finance may be difficult to understand. Moreover, the impact will be different in different cases. The last one, the risk of uncertainty does not exist here. So, investors are able to forecast future prices and dividends with certainty, and one discount rate is appropriate for all securities for all times. These are the different conditions. Or also the firm has sufficient funds to pay the dividend, the firm does not have sufficient funds to pay dividend. Therefore, then what it will do, it issues stocks in order to finance payment of dividends. The firm does not pay dividends but the shareholders needs cash. These are the following formula used to determine the market price of the share. So D1 plus P1 by 1 plus K, dividend per share, price of the market value share uh, at the end of the year. 1 plus K is cost of capital. So the illustration I have given here for better understanding purpose: equity share capital, earnings, price of the share, equity capitalization rate, that is the cost of capital. And if the consideration of the payout ratio is 0% and 8%, 80%, what could be the market price? And if using the model, 0%, 8%, the company proposed to make new investment of 12 lakh 20,000 here. 0% payout ratio, 110 price of the share, and 80% payout ratio, 1% price of the share. So after that, the value of the firm, the value of the total firm is 100 lakhs in both the cases, because here the model is totally representing that even if dividend declared or not declared, you can see all here. Here 0 dividend, here 8 rupees dividend, here price of the share is 110 102, number of shares 1 lakh 1 lakh, total earnings 10 lakhs 10 lakhs, here total dividend 0, here 8 lakhs, retained earnings 10 lakhs, and here 2 lakhs. So investment to be made 12 lakh 20,000, here 12 lakh 20,000. Here they have taken from outside 12, here that is already available here. External financing 2 lakh 20,000 he has taken, here 10 lakh 20,000 he has taken. So number of shares to be issued 2,000, here 10,000. So total number of shares is 1 lakh 2, here 1 lakh 10. Obviously the value of the firm is 100 lakhs in the both the cases. In it's totally represents that the value of the firm is same in both the cases, when dividend is not declared and when dividend is declared. As a result of that, due to this, the it is clearly saying that as far as the model is concerned, dividend declared or not declared, it is irrelevant as far as the value of the firm is concerned. So it is known as the dividend irrelevance theory. Then conclusions of the model: the firm is pays dividend will have to raise funds externally in order to finance its investment plans. When firms pay dividend, therefore its advantage is offset by external financing. Whereas this means that terminal value of the share declines when dividends are paid. The wealth of the shareholders, dividend plus the terminal share price remains unchanged. So, thus, the shareholders are indifferent between the payment of dividends and retention of the earnings. The criticism here as given: presence of market imperfections. So the it is assumed that perfect capital markets exist, which implies no taxes, no flotation cost, and no transaction cost. But however, these are not existing in real life situations. And transaction cost and agency cost. Transaction costs incurred when the investors sell their securities. It is believed that in case no dividends are paid, the investors can sell their securities to realize the cash. But however, there is a cost involved in making the sale of securities. The investors in the desire of current income has to sell higher number of shares, and information is not available. Diversification, they can also do diversification in some other aspects. Uncertainty, and the assumption of certain future profits are uncertain. The future is full of uncertainties, and dividend policy does not affect by the economic conditions. So these are the different criticisms: no or low taxes on dividends. These are the different types of criticisms are there as far as the Modigliani-Miller approach is concerned. This is the last one is a dividend irrelevance theory, residual theory. What exactly the residual theory is concerned? According to this theory, the dividend policy has no effect on the wealth of the shareholders or prices of the shares, because it is totally irrelevant. The theory total the dividend policy is merely financial decision. The earnings available may be retained in the business or for reinvestment. But if the funds are not required in the business, they may be distributed as a dividend. If the decision to pay the dividend or retain the earnings may be taken as a residual decision. The assumption of this theory is that rising finance from external sources involves higher cost. So it is entirely the dividend irrelevance theory as the residual theory is concerned. Thank you. Thank you for watching. Thank you for staying with me. Thank you for your support and thank you for your encouragement. Thank you. Thank you, one and all.